Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. So today we're going to look at oil and some information from Twitter, some quotes. We're going to talk about the market conditions. Um, I always talk about the three pillars: ratios, market conditions, technical analysis. And when I talk about those three things, ratios tell you what the values are doing, what the money flows are doing. If one asset's outperforming another, money's going into that one and not so much the other one. And what we're trying to do is we're trying to find, well, like if I were to describe the golden opportunity, and I'll show you what that looks like from a charting perspective and from a market conditions perspective, what the golden opportunity looks like. Because I partaked in it multiple times and we still have some golden opportunities ahead of us where we can partake in it. Again, it's going to be volatile. It's going to look, we're going to have pullbacks along the way. That's the market. That's the game, baby, right? That's the game. So let's go over some information. I really want to hit the market conditions here. Why do I want to hit the market conditions? Market conditions is what determines asset prices. So when the markets get stressed in a system, people will value things differently. And I'm going to go back and give you that one analogy that I've done a couple of times before. If you're in, a city and you've got water everywhere around you, water's going to be cheap. If you're in the middle of a desert and you are literally dying of thirst, water is then infinitely valuable. Two different market conditions and the valuations put on a certain commodity changes by that person. So the pressures that are put in the system are to people. The pressures on people are going to determine where money flows, and is going to determine where the outcome is of, I should say, the paradigm that people are thinking about certain assets. That's what it's going to mold and reflect. So what we're seeing in the market conditions wise is that we're seeing more and more money transfer to the basic necessities of life. These things are where money has to go because it's a need. It's not a want. And what you're going to see is you're going to see the wants in the world start to decline. Money flows going to wants, and they're going to start to be redirected towards the things that people need. And what are the things that people need? It's going to be energy, food, shelter. Those things are going to take a larger percentage of more people's paychecks. So money is, from that aspect, is going to start to flow to that. And people are going to get agitated because they're going to be working and treading water just to survive. And that's where, their paradigms are going to shift. Things will change. They're going to view things a little bit different. They might get a little bit more defensive with their investments. When you're not making money in bonds, when you're not making money in stocks, people are going to seek things that are working. And if all the money's kind of rotating to food, housing, and energy, then I think those are where everything's going to rotate to. In my opinion, the problem's in energy. And it's a worldwide problem. We are going into a global energy crisis, which we're in, and it's going to intensify for everyone. And as we're interconnected around the world, we could see inflationary pressures actually go and move on up. Why do I say that? Why am I not in the deflationary camp? Because as energy impacts all of these areas and as supply chain problems continue to get worse, if they do get worse, I think they're going to get worse, and I'll give you the explanation why. We're going to have to shut down production of goods and services in Europe. They just don't have the energy, flat out. And your GDP is going to decline. Your parts of manufacture, the supply chain is going to break in certain areas because they supply products to the world. So energy shortages is going to be synonymous with supply chain shortages, especially if you enter this with a bunch of money in the system. Too much money in the system means that you're in an inflationary period. You have too much money in relationship to goods and services, and it's fighting for those goods and services. That is inflation. That's how prices go up. And energy being short is going to take a larger portion of people's paychecks, and more money is going to be diverted to solve the problem of energy. That is the opportunity. And in this mix, depending how long the energy crisis lasts, I think that currencies and bond markets could have problems. And that's why the precious metals look so good as well. I like the physical metals. In an energy crisis, I'm not sure how the mining companies will necessarily do. Because if you're short energy, it's not like, you're looking around like, hey, let's go dig up a bunch of low-grade copper and low-grade precious metals. If you're in an energy crisis, their costs are going to rocket. So that's some things to think about. But let's go over some information here on Twitter. I'd like to, share and give you my opinions on it. So what this person is, this is Vicky Hullab. She's the CEO of Occidental Petroleum. I want to kind of read through this. It says, the world risks living with oil shortage for a while, warns Occidental CEO. The lack of supply will continue to manifest itself as China starts to open up from COVID. The world is at risk of living with a shortage for a while. That will send prices higher. So she is expecting, she or he, I don't know, whatever it is. That person is expecting that we're going to be living with a shortage of energy for a while. That means that I think, in the way that I am translating it, my opinion is that energy prices are going to remain very high and that other areas are going to struggle. And more money is going to go towards energy to solve the problem. But if they continue to do ESG movements, if they continue to have underinvestment in fossil fuels, we could be in a pretty rough situation for a while in terms of energy. Now, here's something also I want to hit up. This is Cuppy. It says, at what point does everyone in finance freak out about this chart? Why are traders so sanguine? Biden cannot even put on his own pants, yet he's scared about what this means. Oil is about to murder every other CUSIP, and investors seem oblivious. I don't get it. And I agree with Cuppy 100%. This is the chart that we are talking about. Now, when you look at this, this is your U.S. Big Four storage, crude with SPR, gasoline, distillate, and jet fuel. If you look at the past 5 years, even in 2019, we were kind of squeezing down on oil here in terms of inventories. But now, if you look at 2021, we started very high from the 2020 up problem here, the medical event. Then we've just gone from the medical event in straight decline all the way down. And this drawdown has been historic by any means. Remember, we have this inventory is going against the highest level of production that we've ever had. These are high levels of production. So as the inventory does not, we should be adding to our inventories to have the same percentage of coverage of inventory in relationship to production. What we're doing is we're drawing down our inventories and we are getting super low. This is this is lining up for a super spike in oil. And that is going to change the way the markets react. If we see oil at 200 or 250 or 300, I don't know where this thing's going to top out. I don't know. Historically, if we look at gold and gold's at like 1800, I could easily see a $200 a barrel oil, given that gold stays roughly where it's at. So, 170, 180, that's a 10-to-1 ratio. We've gotten down to 6-to-1 ratio before. A ratio of 6-to-1 at $1,700, we'll do $1,750 divided by 6. That gives us at $291 a barrel. I think anywhere between $200 and $300 is probably a good likelihood. Given the now, I also want to talk about this as well. This is our inventories. We're down another 15 million barrels. I want to go to, and I shared this a little while back, this one here. This is also U.S. petroleum crude products and SPR inventories over a longer time frame. What you can see is that we were at levels, inventory levels that were going up. During this crisis back here, the commodity boom, I should say, during the 2000 to 2008 commodity boom, what do you notice in this chart here? We've noticed that the inventories of all of these were increasing during that bull market. What was happening in the previous market conditions? Now, I'm talking market conditions here. This is important to grasp, in my opinion. During that last bull market in commodities, in particular oil here, because that's what we're focusing on. Oil was going up inventory-wise, but the price was going up alongside of it. It was credit coming into the system that was causing the boom. It was a financially driven event. So more money flooded into the system, and oil was a money rotated because interest rates were going up, and it went into oil and other commodities. What's different here now is if you look at the right-hand side and you're seeing this drawdown in our inventories, we've broken that uptrend of inventory increases, and now we're declining in our inventories of oil. That should be a huge alarm bell in your head going, this is different than the previous bull market. The molecules aren't there. This is a shortage, a physical shortage of oil, and no one seems to care about it. Now, here's something that's a little bit different. Notice the level of inventory that we're at today. Go to the left, and that's the same as where we were in 2006, 7, and 8. What was the price of oil in those time frames? And if we go back and we look at the time frame of crude oil during those time frames there, we back out. Well, in 2006, it was $75 a barrel. And in 2008, it was $140 a barrel. So we had pricing at 75 to 140. And that was during a time frame that we were barely drawing down inventory. We were just kind of barely drawing it down. We were at a decent level. And remember, we had lower production at that time. We had lower demand, lower supply in the mid-2000s. Now we have higher supply, and we're eating through our inventories at a very fast clip. I don't see a stopping point yet here. And if China comes back online with a lot more demand, supply of barrels comes off the market in Russia, and we're at the lowest inventory levels worldwide that we've been in relationship to the demand. Think of it as a ratio, a percentage of the demand ratio coverage. We're going to see some crazy stuff, I think, happen. And it's going to impact financial markets in a negative way. We're going to see more inflation. We're going to see CPI numbers start to blow up to the upside, if and when this cannot be slowed down. So that is a huge deal there. Now, looking at, I'm going to go to my ratio here real quick. Looking at the gold to oil ratio here. Let me pull it up right here. We've got it somewhere, which I blew right past it, of course. Okay, it's right here. So the gold to oil ratio, when I was talking about the golden opportunity was here because when you look at history, we've never priced oil so cheap to gold ever. We've never priced oil to anything that cheap ever. That was the golden opportunity because if you knew ratios and you just said, you know what, I'm going to buy when it's cheap, it came and it came back. This would have been the buying opportunity this month here as it came and came back down, buy into strength. That was the opportunity there. It was even an opportunity here that was back in the mid 2020s, the summer and fall of 2020. And then we really took off. Now, looking at this ratio now, if you look towards the right-hand side, what do we see here? And I wrote this before. I've showed you guys this multiple times as this was going up. I said, we're going to do a retest, breakdown of the support line. So what we did is we've been heading lower in this ratio. Oil's been outperforming gold. And oil's been, I would say, a great investment. Still is. And we broke through the long-term downtrend line. So let me back out here and show you what we did. And this is a big long-term down, or a big long-term trend line. It's not downtrend, it's an uptrend line, but this is that long uptrend line. And what you do usually is you break through it, and then you do a retest, and then you break back down again. And we've got another bearish engulfing setting up on a monthly candlestick basis right now, which means that we are going to go, most likely, oil is going to outperform gold. So when I look at this, we've got the huge move lower and compression of oil versus gold, which is favorable to be invested in oil. We have broken out below the downward, the lower trend line. That's the blue line going across. We've broken out to the downside. We did a return move. And what are we doing now? We're breaking to the downside again. This is signaling that the big move could be coming, because we've done our retest and now it's full compression time. Last time the bull market in an environment where we didn't have inventory drawdowns as drastic went to a ratio of about 6. That's what we draw down to. Let me see if I can get a little bit more. We're going to go to the last bull market in the mid to late 2000s. So we go down here and it compressed all the way down. Let's put a little, I think there's a value tab in here, if I remember right where it's at. It is hold on. Right here, it's at 6.5. So we went down all the way to about 6 or 6.5, about 6.5 on the ratio. And if that were to repeat, we'd be at about upper 200s for the price of oil, given where gold is today. So it's like 6.5. And then we had that large compression all the way down to 30 and the crash. I think that's going to happen again. We've got the same kind of similar setup that looks so juicy here, and we're compressing that oil to gold ratio. Oil is outperforming. So that's one thing I wanted to talk about here. And again, another golden opportunity, just so you guys, I know it's not oil related, but it's commodity related. This is where I was buying, I was early on this move on the turn. And then we're breaking out, and we're heading higher on the CRB to S&P 500. Commodities are still outperforming. And I think this is going to get a big kick in the butt here very soon with a big move higher of commodities outperforming in relationship to stocks. Oil is going to be our leader. So these are all interconnected. And oil, I think, is going to, we're going to see how tight the oil markets are going to get this winter, in late 2022, early 2023. And then even into the summer of 2023. This is going to get super tight, guys. So put your seatbelts on, lock up, and get ready. Because this is it. This is the main show. It's coming. And, is uranium going to take off in some of these other markets? I don't know. I know a lot of people, they look for answers. And they look for predictions. I don't do predictions necessarily. I say this is kind of what I think's going to happen. They're not set in stone, but they're based off of inventory levels. And oil, I think, should be 120, 130 based off inventory levels right now. And if we don't see supply response, we're going to 150, 160, 180, 200, 210. I don't know where it's going to top out at. I don't know where the demand will necessarily be destroyed. I don't know what the crack spreads will be in gasoline. I don't know what's going to stop that. So we're going to have to look at that together. And so definitely subscribe, and we can do that together on this channel here. But it's coming. That's what we're looking at. We're going to see higher natural gas prices as well. Let's take a look at natural gas real quick, since I've got this up. Natural gas is heading a little bit lower in the short term, and I do think that we could see a little bit more of a pullback left in it. And the Freeport comes back online late November. Now, let's just do it. We'll do a crude oil to natural gas ratio. I haven't done that in a long time. And what we're seeing is an outperformance of crude oil. Crude oil, I put these marks on here. We we had a very nasty spill in natural gas all the way down in 2012. But even in 2020, it was really cheap. In 2020, that's where I was looking at it. We've gotten lows all the way down to 2.79 in 2001. That's a very historical low. And then we went into a bear market of natural gas from 2001 all the way up to 2012 in relationship to crude oil. In relationship. And then I think what we're doing now is we've had a nice good compression here, and I think we could see crude oil start to outperform against natural gas even. But that's what we've got there. I think the main event's coming, guys. And it's going to be this winter and next summer. That this winter is going to start here any second, and the markets are going to front run. You don't want to wait right up to the time that Freeport comes back online. The markets are going to front run it. So natural gas is going to move before Freeport comes back online. The exact bottom, I don't know. It's going to be soon. It's going to be this month. You should be looking at your natural gas companies. You should be saying, you know what? Where should I be positioned? How should I position? That's going to be different for every person. What I'm doing is I'm looking at my favorite companies. I'm cost averaging in. I've already cost averaged in. I'm going to continue to cost average in. And if we get better buying opportunities, I'm going to keep going. I think that natural gas, I think that oil, it's here. It's here, and we're going to start to tighten. We've broken the downtrend in oil, at least dollar-wise, to the upside, and the tightness is there with OPEC tightening up the markets. And when the Strategic Petroleum Reserve ends, the releases, and I don't know when that's going to do. I don't know if they're going to extend them. I don't know what the heck they're going to do. It seems like OPEC is fighting the Strategic Petroleum Reserve releases. We'll see some crazy stuff, I think. So that's my opinion there. That's the market conditions. I think it's very energy driven. I think inflation is going to go up, and I think interest rates will continue to go higher as long as energy's tight. All right, guys, that's all I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Yeah, that way. Subscribe to the website. And definitely hit up the 5 p.m. Sunday Mountain Standard Time question and answer session for the Platinum members, if you want to go there. But that's when we have that session. Go ahead and ask all the questions you want. I'll give you my opinions on it. And we'll see you there. All right, guys. We'll catch you next time. This is Finding Value.